Hi, this is Professor Karen Lin. Welcome to the Financial Accounting for Undergraduate Students. In this video, I'm going to introduce revenue and expenses recognition in the form of journal entries. You'll be reinforcing the idea of transaction analysis and journal entries writing. Let's get started. In the previous chapters, we talked about transaction analysis based on the equation asset equals to liability plus stockholders' equity. When we analyze the transaction, we have to make sure the effects of the transaction will make our equation remains equal. In this chapter, because we start talking about revenues and expenses in the income statement, we are going to expand our transaction analysis model to include the revenues and expenses. Now, net income equals to revenue minus expenses. We learned that in chapter 1. This equation will be linked to our balance sheet equation, asset equals to liability plus stockholders' equity, using one account called retained earnings. Remember, retained earnings means that the earnings or the net income that are accumulated in the firm without distribution in the form of dividend. So retained earnings basically, we talked about before, equals to the beginning balance of retained earnings plus net income minus dividend. So when a company recognizes revenue, that would increase the net income and thus increase retained earnings. On the other hand, if a company has incurred expenses, that would decrease the net income. And decreasing net income would decrease the retained earnings. So any transaction that has an income statement effect will also have a balance sheet effect through this account called retained earnings. Retained earnings is also called earned capital, versus when the shareholders purchase a common stock, it's called contributed capital. So here's how we do our transaction analysis. Step 1, you should ask yourself, what's a revenue earned by delivering goods or services? If the answer is yes, you want to debit account for what has been received and then credit the revenue account. Or you would ask yourself, what's an expense incurred to generate a revenue, remember matching, in the current period? If the answer is yes, you debit the expense account and credit the account for something that you have to generate the expense. Or if neither a revenue or an expense has incurred, you would debit the account for what was received or credit the account for what was given. Now, I'm going to decompose this transaction analysis into detailed examples, but this is the step 1. Step 2, you want to verify whether what you have done in step 1 makes your accounting equation still equal. Do your debit equals to your credit? Now, again, when we recognize a revenue, there is a dual effect. Revenue will be increased and retained earnings will be increased. Retained earnings is under stockholders' equity, so plus R plus SE. And if you recognize an expense will be increased, but that would decrease stockholders' equity, specifically retained earnings. Remember, debits equal credits. All right, let's get started. So remember, in step 1, we first asked, what's a revenue earned by delivering goods or services? If you deliver goods or you deliver services, you earned the revenue. So here's an example. Chipotle sold food to customers for $1,359. $44 was sold on account, which means you're not receiving it right now, you're receiving it later. And the rest was received in cash from customers. So when we analyze this transaction, the first thing we ask ourselves is that, is anything earned? The answer is yes, because you sold food and beverages to the customers. So obviously, we have earned sales revenue for the amount it incurred, so $1,359. On the other hand, you will see that we received cash, and also some accounts are going to be received in the future. Both of these accounts are asset accounts, so when asset account increase, they increase on the debit side. So $13.15 cash and then $44 on account. If you add these two numbers up, it should equal to the credit side. If you look at the equation would be cash increases, accounts receivable increases, and stockholders' equity retained earnings increases. Now your left-hand side of the equation equals to the right-hand side of the equation. You can also post this entry to the T account, right? You would credit revenue, and then you would debit cash and accounts receivable. Now the second entry is an opposite example. So during the quarter, Chipotle sold gift cards to customers for $35 each in cash. The question to yourself is that, is this a revenue, right? Recognition. Should I recognize revenue? The answer is no. You can't recognize revenue because when you sold gift cards, you basically just sell something to a customer without in exchange of any services provided. You're basically only selling a gift card, and then the gift card can be exchanged for Chipotle services in the future from the customer. So in that example, this is not a revenue because the service has not been provided or goods has not been delivered. Step 1 tells us if neither revenue nor expenses was incurred, you would be asking yourself what has been received and what has been given. So we received cash for $35, but we have incurred liability, which means in the future when the customer exchange the gift cards with Chipotle food and beverages, at that time revenue should be recognized. So it's recognized as unearned revenue, which is a liability account. Your accounting equation will show the asset side increases and the liability side also increase for the same amount, and your equation still equal. The next example points to the idea of expenses recognition. Chipotle paid $65 as training expenses for management during the quarter. So we ask ourselves, is this an expense? The answer is yes, because without proper training, the managers cannot perform their duty during the quarter. So it's an expense that matches the revenue for the period. So we need to recognize the expense by debiting the expense. Now, if you would remember a law, assets and expenses are increased by debiting those accounts. So we need to increase the expense accounts by debiting an expense. And what have the company paid or give up to in exchange for the expenses? It's cash, because Chipotle paid cash. So when you see in an exam or in your homework, if you see paid or received, you know cash account would be involved. All right, so that's an expense recognition. Now let's look at another example. In this example, Chipotle purchased food, beverages, and packaging supplies, costing $459 during the quarter, paying $379 in cash and owing the rest on account. So is this a revenue? No, you didn't sell anything, right? You didn't exchange service of food or goods for future resources. Is this an expense? Did you use anything for generating revenue? The answer is no. There's nothing used or spent to generate the revenue. You just purchased some supplies. And what is the nature of the supplies? Supplies are assets because one, it's an economic resource. 2, the company owns or controls it, right? 3, it provides future benefits. In the future, you can sell it, so it provides future benefit. 4, it's measurable. So supplies are assets. We need to increase assets with a debit side, so we would debit supplies plus A for $459. Now you ask yourself, what have we been given up, right? Cash, and also on account, we are going to pay in the future, so it's payable. We gave up some cash, and we also promise we have some obligation to pay in the future. That's liability. If you look at the accounting equation is affected on the left-hand side under assets, and also the right-hand side under liabilities, and your debit side equals your credit side added up. All right, next example. In this example, at the beginning of January, Chipotle paid $207 cash for rent, insurance, and advertising to be used in the future. Now, pay attention to the wording. These are things that to be used in the future, which means it hasn't been used at this moment when the transaction happened. In other words, it's like a deposit. So we paid deposit on a property that we are going to rent in the next quarter or year. So these are all considered prepaid because we haven't been using it yet. So prepaid expense. Prepaid expenses are not expenses, although it has an expense wording in the account name, but it's not an expense. Prepaid expenses are assets. So because, again, prepaid expenses are economic resources that controlled by the firm and to provide future benefit, right? Because rent, insurance, and advertising are going to help us earn revenue in the future, but not now. So without us or without the firm using those expenses or those resources, it can be recognized as an expense because it's not being used. So we are going to recognize it as prepaid expense, and then we are going to credit cash. You can see the effects would all occur under the left-hand side of the equation, and they cancel out. So there's the net effect of these two accounts will be 0 on the left-hand side, and there's no recording on the right-hand side, so 0 equals to 0 plus 0. So our equation is still equal. Here are a couple more examples. Now, in the following examples, I will show the example first, and then I will ask you to pause your video when you saw those examples and think by yourself or put down your answers on a piece of paper so that you know whether you get the materials or not. The first one, Chipotle paid employees $342 for work this quarter and $47 for work last quarter. First of all, you ask yourself, is there any revenue? No, right? We didn't sell anything. Is there an expense? Yes, you paid someone for the work this quarter, which means you pay someone to help you for your business that generates revenue. So this is an expense. You pay for the work last quarter. Now, the work last quarter has nothing to do with the revenue generated in this quarter. So there's this 47 for the last quarter is not an expense for the current quarter. Okay, remember the periodical assumption? So you should be putting down the wage expenses, $342 for the work this quarter. And the 47 is just a payoff of their workers' work for the previous quarter. You must have already recognized it as expenses in the previous quarter, so you can't recognize expense again. So in this example, you would be debiting payable, wage payable, which means it is a liability that carry over from last period, which is paid off this period. What have we been given up, right? That's what have we given up? It's the cash. Reducing an asset $389. So we paid $389. $342 is for current period considering as expense, and then 47 is for the previous period, which is a payoff of the liability. All right, the next transaction. Chipotle sold land costing $21 for $12 cash. Because we sell something cheaper than it costs us, it results in a loss. So you're going to ask yourself, is this a revenue? Did you sell something? Yes, we sold something. We transferred the land to our customer. So it's we should recognize revenue in this example. However, it's not a revenue, it's a negative revenue, which is a loss. So we should recognize a negative revenue basically. And what have we given up? We gave up a land, right? What have we received? We received cash. So now you can write your journal entries based on what we discussed. And pause the video. All right, now let's take a look at the entry. As we discussed, we have received cash $12. We have given up a land for $21. Our debit needs to equal credit, so the debit 12 and the credit 21, the difference between the two is 9. You can see the 9 is on the debit side rather than writing a revenue -9 on the credit side, because we cannot write negative numbers in our journal entries. So rather than writing revenue of -9, we would just use an account called losses, and losses are on the opposite direction of revenue, so we would debit a loss for 9. Our debit added up equals to our credit. Now what about this one? Chipotle paid $117 for utilities used during the quarter and paid $35 for repairs of its buildings equipment during the quarter. If you would pause the video for a little bit and think about it, and I'll talk about it in a minute. All right, so you will see here, is there any revenues and expenses? First of all, you will see there's no revenue because we didn't sell anything, but there might be expenses because we pay for something, we spend resources. Now, when we spend resources, we look at, first of all, whether it belongs to the current quarter, right? It does. It's during the quarter and during the quarter, so it belongs to this quarter. Do we use it to generate revenue? Yes, because if you don't pay utilities, you won't be able to use utilities to generate your revenue. If you don't repair the buildings and equipment, your operation won't be functioning. So these are resources spent to generate revenue, so they both are expenses for the current quarter. So in contrast, I just want to show you what we did a couple slides before when Chipotle paid employees for the work this quarter and $47 for the work last quarter. So now the last quarter part is not an expense because it's not matching the revenue of the current quarter. Instead, the utilities and building equipment repairs are both for the current quarter, so they both are expenses accounts, should be recorded as expenses. So you would debit utility expense, you would debit repairs expenses. What would you credit? What have we given up? We gave up cash, right? We paid, when you see receive, paid, cash account is involved. So we paid cash, $152. The textbook has a guided help video 3-3, which provides another set of examples and illustrations if you are interested or if you need that. Okay? All right, I'll see you in the next video.